Welcome to your virtual CFO coach. I'm your host, Leah Torbert, founder and CEO of Harrington Strategic Partners. I've spent my entire career working in the startup world, scaling businesses to multi-7 and 8 figures. I built this podcast to share all of that knowledge with you and make your path to success shorter and easier. Tune in each week as I cover topics including financial analysis, cash flow management, holistic strategy, mindset, and more. Now for today's episode. Hello everyone. Today I want to talk about account reconciliation. Sounds like a really fancy thing, but it's actually pretty easy to do. So I'm going to start with explaining what it is. Account reconciliation is the process of comparing your statements and other documentation like invoices, payments, and delivery receipts to the transactions that are already recorded in your accounting system to make sure that they match and that they are complete. This process is essential to have accurate financial data for your business decisions. Depending on the size of your company, you could have a few dozen transactions, a few thousand transactions, or anywhere in between. And your accounting system may have the ability to download transactions automatically from your various online accounts, or you might have to enter those transactions manually or somewhere in between. Either way, there's still a lot of room for error, and that error is why we do account reconciliation. So what types of accounts are we talking about when we hear the term account reconciliation? Typically, we're going to look at accounts like your bank accounts, and then your cash payment accounts like PayPal and Zelle and Cash App. If you have petty cash, like a little petty cash envelope in your office that, you go buy donuts and stuff with, you need to actually reconcile the amount of money that's in there. Your accounts receivable, if you track AR, your credit card accounts, your loan accounts, your accounts payable, if you track AP, if you have payroll or sales tax liabilities that you need to take care of. And then if you have inventory is also something that should be reconciled. The account reconciliation process identifies several types of errors so they can be corrected in the system. And today I want to talk about the 5 common data mistakes that the account reconciliation process actually finds. The first mistake is missing transactions. So I'm sure anyone can think of a busy day at the office where it took all of your energy and focus just to get orders out the door and complete a project on time. And maybe while you were focusing on the customer, because obviously if the customer is not happy, your business is not going to be doing well, you told yourself that you'd handle all that pesky paperwork later. And then you didn't. It happens. We all get busy. We all say we're going to do something, and then we get distracted or something else comes up and we just don't get back around to it. Or maybe we had to call in the emergency AC repair guy because, let's be honest, if our AC is not working, nobody's working. I'm in Texas. It's 110 degrees outside. Believe me, the last thing I want to do is do any of my work if my AC's broke. And this actually happened to me a couple of months ago. And thankfully, it took less than 24 hours to get everything fixed. But a different tangent, having that AC guy, really important. But when you hand over that credit card, you're not really worried about, oh, I've got to go record that in my accounting system, if it's a business expense. You're just worried about the AC working, right? You get the receipt, it goes in the pile of paper, and then you forget about it because you're busy cooling down. You get the idea. And all of these little things can add up to a large variance in what our financials tell us versus what really happened. And the account reconciliation process catches these errors and ensures that our balances are correct. The second data error that can happen is you could end up with duplicate transactions. Remember that busy day? Maybe you did enter the customer invoice, but you forgot about it. It went back later to add it, accidentally duplicating it. Or, as QuickBooks Online does sometimes, duplicate transactions were downloaded into your file and you didn't realize it. Duplication errors also create distorted financials and can have a huge impact on the decisions you make based on them. Account reconciliation catches these two. All right, let's talk about the third one. Transactions posted to the wrong account. This one gets a little tricky. It's less visible because your payment account balances may be correct. So the bank that you paid with or your credit card that you paid with, you recorded the transaction, so your balance is good there, but your offset account wasn't right. If your offset account is an expense account, you need a good understanding of what your typical monthly expenses are to see a variance on your income statement. What I do is I like to run an income statement report for the year to date, and then I toggle the option that says show the data by month so I can see what's happened month over month. This lets you easily compare the month-over-month changes for each expense account to see if any red flags pop up. This is high level. You haven't looked at the detail yet. But when you're looking across the months, if you notice that your office expenses are usually around $500 a month, but this month they've jumped up to $6,500, or maybe you're looking at your expenses and one of them for some reason is negative, that's a red flag. It's definitely worth a few minutes to dive into the detail for those accounts and see if maybe something got posted somewhere that it shouldn't be. Finding errors on the balance sheet is a little easier because many of the accounts are reviewed through the reconciliation process. A good example is posting a credit card payment to the wrong credit card. That will jump right out at you when you're reconciling the credit card. The fourth data mistake is having the transactions with the wrong amount or date. A good example of a transaction posted with the wrong amount is a restaurant receipt. Sometimes the tip isn't recorded on the customer copy, or the total with tip may not be correct. And if the receipt was manually entered into the system with the wrong amount, then it won't match the statement. This actually can lead to two errors. The balance of your account will be off because the amount was wrong, but also if the transactions automatically download from your bank or credit card into your accounting system, this could lead to a duplicate transaction because the system doesn't know that those are actually the same charge because the amounts don't match. It's maybe the same date, the same place, but if the amounts don't match, then the system thinks it's actually two different charges. So if you're going through and clearing out all of those transactions and you don't catch it, then now you also have a duplicate as well as one of those balances being wrong. So why are dates important? If the charge was on the 23rd and you recorded it on the 24th, it doesn't really matter unless you're a perfectionist like me. When I'm entering things into my system and I accidentally key the wrong date and then I realize it afterwards, I can't ignore it because that's just how my brain is wired. I realized it was the 23rd and that I typed the 24th and I have to go fix it. That's just how I'm wired. But if the charge happened, let's say on the last day of the month, and you record it on the first day of the next month, or let's say it's the last day of the year, and then you record it on the first day of the next year. So basically what you're doing is you're crossing months or you're crossing years, then it does matter. Financial statements are the window into what happened to your cash and when. And if you're trying to understand how much it costs to run your business every month, date errors like this can add up. $5 here or there may not seem like a big deal in the scheme of things, but if you're posting big transactions, if you're buying equipment, if you're paying for large-scale repairs, if you have an inventory shipment come in, all of these kinds of things can have a really big impact on what your financials say. And then you're going to try to make business decisions off of that. So your expenses may seem higher than they should be, or your revenue could seem higher than it should be, or vice versa. And then you're taking that data and figuring out what you're going to do for the next year and how you're going to grow your sales or reduce your expenses. And you're not actually working with the correct data. Something else that this can also cause is a tax impact. So for example, if you file your taxes on a cash basis and you record a customer payment in December when you actually received it in January, you're going to be paying taxes on that in the December tax year instead of the January tax year, assuming your fiscal end is December. So why would you pay more taxes now than you have to? Like, actually recording things on the right date can have a serious impact. Okay, let's go to number 5, payment discrepancies. Let's go back to that busy day. You shipped out several orders and processed some customer payments. And then you processed some online payments for a few of your open bills. But you were really busy and you told yourself you'd get around to it later, and you didn't record those payments in your accounting software. What happens when you run your reports? Your receivables report is going to show that your customers didn't pay, and your payables report is going to show that you didn't pay. So if you're not reconciling your accounts, this could lead you to hassling your customers for money that they've already paid you, and then you paying your vendors twice. Neither one of those things is a good business case. So it's definitely worth it to take the time to reconcile your accounts on a regular basis. So another question I get asked a lot is, how often should you reconcile? If you receive a monthly statement, your bank account, your credit card account, say you've got a car note, reconcile on a monthly basis. One statement, one reconciliation. If you have a large volume of customer and vendor payments, it may be better to review those payments on a weekly basis to make sure that everything has been applied correctly. Make sure to send out monthly statements to your customers. And if you track your AP, make sure you're asking for vendor statements as well. That way you can check the statements that come in and make sure there's no mistakes on their side. If you carry inventory, it may not be feasible to reconcile your inventory on a monthly basis. Doing so on a quarterly basis or a semi-annual basis can be good alternatives depending on how quickly your inventory turns. Another option is to implement cycle counting, breaking down your inventory into groups and then counting those groups on a rolling basis to continuously update your inventory balance. If you want to learn more about the actual reconciliation process itself and how to implement that into your business, go check out the article that I wrote called Implementing Your Month-End Close Process. I will have a link down in the show notes so you can go take a look at that. It outlines how to evaluate what you need to do, when it needs to be done, who should be helping you with it. So it gives you your roadmap to getting to the end phase where all of these data errors have been caught and they're being caught sooner rather than later. So what if you don't have the time or you simply don't want to do this yourself? The simple answer is give me a call. If you're using QuickBooks Online to manage your financials, I can help. I offer bookkeeping cleanup services as well as monthly bookkeeping so that you don't have to worry about the hassle of making sure all this stuff matches. All you have to focus on is growing your business and do the things that you do best. So here's how the process works. You can book a discovery call with me. I'll have a link down in the show notes. We'll have a quick chat. We'll talk about what's going on in your business and whether it makes sense for us to look at things a little bit further. Thanks for listening to today's podcast. If you enjoyed what you heard today, please share with your network and leave a review. If you have any comments or additional topics you'd like discussed on the show, let me know. Before you go, connect with me on LinkedIn and let's keep the conversation going.